talked previously mostly generally about investments and investment strategies, and wanted to talk a little more specifically about approaches to investments and some important considerations to make when you're addressing your investment strategies and investment needs. Like, what are the costs going to be to implement this portfolio strategy? Or what are some of the tax implications associated with a particular investment strategy? And even what are some of the broader options available to assure that a portfolio is strongly diversified? These are things that, while they might be generally addressed or thought of, some of the more specific components of these decisions, which could be very critical to the success of an investment plan, may not be considered. And really, the interaction between the investor and the advisor is critical to assure that these topics come up and are addressed. One very important element of that is considering the broad range of investment options that are available, so that you're understanding completely all of the different potential approaches to creating an investment portfolio. For example, using exchange-traded funds, using mutual funds, using stocks or bonds or commodities and gold and energy to create a portfolio that fulfills your objectives, is consistent with your needs and your long-term planning and investment objectives. One of the important areas of investment decision-making is diversification, trying to assure that your investment portfolio is diversified and not assuring that you're not considering just one particular component of your investment portfolio, whether it's a retirement plan that you have or a joint brokerage account that you might own or a particular annuity product. The point being that you need to make sure you're assessing your overall investment portfolio when you're considering your investment strategies. Diversification can be very generally applied to the popular components of investing, like large cap stock positions or mid cap stock positions or value or growth oriented stock positions. But it's also important to assess whether you have diversification along different investment sectors, like energy sectors or health and sciences or international investments, so that when you're assuring that you have a broad, strong diversification in all of your investment accounts, you're considering all of the different factors associated with having a diversified portfolio. Another very important element of investment strategies are the costs associated with implementing your investment strategies. It's important to understand all of the components to those costs, the investment advisor fees that would be associated with an investment strategy, the underlying fees related to the investments themselves, such as the mutual funds or the exchange-traded funds. There's generally a cost associated with holding those, and so it's important to work closely with your advisor to understand what the costs are going to be that are associated with any investment strategy that you're implementing with respect to your overall portfolio. So while it's important to assure you have strong diversification and an excellent investment platform, you need to know and understand what the costs associated with those strategies are and how they're going to impact the long-term investment returns of your portfolio. From an investment advisor cost perspective, there are different ways that an investment advisor will charge fees. It could be based on the overall value of a portfolio. It could be commission or transaction based. And so as you're assessing the costs associated with your investment strategy, and particularly with your investment advisor, it's critical to understand how are those costs being applied to your particular investment strategy and account, so that you understand and know what those fees are and how they're being charged. It's critical when you're formulating the investment strategy to focus on life objectives. It's very important for your investment portfolio to be consistent with your particular needs, whether it's liquidity that you know you're going to need money for a particular investment, whether you're saving for college for your children, whether you're saving for retirement, or any particular investment that you expect to partake in the near future. The key is that you're looking at your life objectives, the timing associated with them, the horizon upon which you expect to meet those individual objectives, and you're aligning your investment strategy consistently with those objectives and that overall life plan. It's also important to work closely with your advisor to assess external factors. While you can kind of define and outline what your particular life objectives and the personal factors associated with your investment decisions are, to really understand the external factors and how that might apply to investment strategies and investment decisions is not as simple as that. There obviously could be market or economic conditions that are important to the timing of the decisions you're making about your investments. There could be general world uncertainties that exist that would require you to consider different strategies or the timing of those strategies. So working closely with your advisor to not only understand your personal needs and your specific life goals and objectives, but to look outside of that and to assess the external factors that might have an impact on making a decision about the types of investment strategies that you want to implement. And it's important with the investment strategies to, after you've made some of the initial assessments about your specific life objectives or about the external factors that might impact those decisions, that you're monitoring and reassessing on a fairly regular basis so that you understand how changing environments or changes in your own personal life situation might impact how you want your investments to be structured or possibly impact changes that you might want to consider for your investments. It may even be that particular positions or investment vehicles that you've utilized need to change a little bit, or you might want to modify the diversification of the existing investment strategy that you've already implemented. There could be reasons for market conditions to impact one part of your portfolio more than another, and therefore require you to readjust or modify some of the strategies that you've initially implemented. So revisiting and reassessing is important to do, and working closely with your advisor to assure that you're making those reassessments is critical. Another important factor to investment portfolio strategies are the tax implications of the investment portfolio. Oftentimes, there are tax implications associated with the income derived from an investment portfolio. And so while you could have an investment portfolio that may or may not be increasing significantly in value in a given year, there could be interest or dividends or capital gain income that result in tax liabilities associated with that portfolio, regardless of whether it's increased or not in value. Working closely with an advisor to structure an investment portfolio that is consistent with your tax objectives as well, and understanding that there are different investment vehicles that will impact you differently as far as taxes go, depending on which vehicles you've selected. So it's critical to assess your tax circumstance and assess how the investment portfolio that you've structured will impact you from a tax perspective, so that you can try to create as optimal of a strategy with respect to tax liability. So in general, from an investment approach perspective, there are several very critical areas to consider as you're putting together an investment portfolio and an investment strategy. And so it's critical to work closely with your advisor to understand the specific options that are available to you and assure that you're building a portfolio and a strategy that is very closely aligned with your goals and objectives.